in the focus of many lenders is nowadays residential logistics, and then to a certain extent prime office has come back. We have seen a tightening of margins, but that's a very constrained, limited part of the market.
Alexander, pleasure to have you here today. I would like to ask you to introduce yourself and explain your role at DWS.
It's a pleasure being here. So I am responsible for the European real estate debt funds at DWS. I originally joined DWS 10 years ago, and I've helped build up the debt fund business over the past 10 years. And we are running a institutional fund business for mainly European and Asian insurance companies and pension funds and institutional investors, and pooling these funds for investments across the capital stack, so senior, whole loans, mezz up to pref equity.
How are lenders approaching upcoming refinancing waves aimed raising rates, lower valuations, and tighter credit conditions?
That's obviously the big challenge. And, if we compare the lending situations to like 2 years ago before the rate hike cycle, it's obviously on average still kind of like higher margins and lower LTVs than 2 years ago. And then obviously cost of debt with a different base rate is much higher. And then on top, our underlying real estate asset values have repriced. And, as such, refinancing for all these loans originated in the low interest environment is a challenge, especially if we think about our secondary offices, which have repriced maybe 40% plus. And as such, there is a funding gap. There's a refinancing wall, as some people call it. But that being said, there have been big numbers out there, right? That can be 150 billion plus of a funding gap. But obviously that hasn't really materialized, because a lot of the situations, and we probably come to that as part of our discussion, have been extended, are still in workout, right? Have been solved maybe with different solutions, bringing in some fresh capital. So it's overall, I think it's a complicated question, and it is challenging to refinance loans out of the low interest environment.
And how is the cost and availability of debt evolving Europe's core and secondary markets? And what impacts are you seeing these have on deals flows and refinancing feasibility?
I always like to segment the market almost into two buckets. One is what I call the higher debt liquidity segment, and that's, I think, if you go into a bank's credit committee and it ticks all the boxes, there's a lot of funding again for this kind of prime lending product. And on these loan types, we have seen a tightening of margins. But, that's a very constrained, limited part of the market. As soon as and I think that picks up on your question, secondary markets, as soon as you step out of that, anything that needs you're a little bit more of a real estate story, you have more complexity on the structure, you have a less favorable asset class, there is much less liquidity out there. And this is to a certain extent for alternative lenders the play field, because here you have less competition, less bank competition out there, and obviously a different pricing and structuring environment. And I think as such we do have this hybrid solution or kind of hybrid development, because Europe will continue to be a heavily bank dominated market, but the alternative lending market is growing. It's at the moment about 100 billion euros market plus minus. And, if we increase the share, as it's today from continental Europe from 10 to 20%, it's a market that can double, right? And obviously help, on these kind of refinancing situations.
Now, let's talk about sectors and different regions as well. Where are the sectors and regions presenting best opportunities for lenders and debt funds currently?
Yeah, it's on sectors. It has been in the focus of many lenders is nowadays residential, logistics, and then to a certain extent, prime office has come back. I think that's like if you talk a lot about the lending portfolios, that's the focus, right? And that's the most favored asset classes with the most robust fundamentals. That's probably like the best play in the market from a lending perspective. Talking about countries, it's of course the big countries: France, Germany, UK. UK quite dynamic, much more active, kind of like even like on the acquisition side. Germany, we just had the German session, the German breakout session before. It's slower, much less acquisition activity. Banks have extended more to a certain extent, have been less aggressive in terms of like cleaning up their balance sheets, but it continues to be a big market, and given like the future 500 billion infrastructure package, which we need to feed into the economy, so there is, I would say, like upside potential as a market opportunity. At the moment, Spain is running very successfully. Always used to be a good risk return profile, are doing economically well. And what is to a certain extent the comeback this year is Italy. Just to a certain extent, the Corona programs which were launched are feeding into the economy now in the southern European countries. And, that definitely helps stabilize these markets. And you see a lot more activity than 1 or 2 years ago.
What are the biggest hurdles ahead, and how can lenders work collaboratively with borrowers to rewrite playbooks before defaults reshape the markets?
Yeah, it's in a challenging refi situation. It in many cases comes back to capital, because if you have a office building which has lost tenants, you need to reinvest back in the building to make it attractive and lease it up. Leasing is very expensive on the office side. And, as such, you need to come up with a funding solution with, in many cases, for example, the equity being out of the money, but, still maybe being willing to help operationally on the asset. And then the senior banks are maybe being like a consortium and, trying to find a solution who can fund and at what point of at what level of the capital stack. No? And I think that's in many cases that requires a lot of discussions. Maybe this requires certain out of the box solutions or fresh capital coming in. And or of course there's always the consideration, what's the market value under more or less a fire sale as of today. But if you get a broker opinion of value on these kind of a little more troubled loan situations, you typically end up with proposed values that are significantly underwater, including the banks. Because if you value an asset at a 20% plus levered IRR requirement, you're quickly below the senior loan amount position.
Now, final question. What kind of topics or issues are you talking outside of the official discussions here at the event? And during the coffee breaks, lunch, what are the main concerns among the players here?
I think overall it's always great to have these conversations here. I think a lot of conversations around back leverage, and to a certain extent a certain tightening of margins, and how much can back leverage a little bit mitigate that, right? Or to a certain extent, how tight can the margin be? So it still works for an alternative lending product. So, it's one part of the conversations I picked up today.